Hello, it's my pleasure to welcome you to the fifth panel session of the conference. My name is Peter Easton. I am a professor of accounting at the Mendoza College of Business at the University of Notre Dame in the United States. I am also the director of the Center for Accounting Research and Education, known as CARE, which is responsible for generating the idea for this conference, for gathering the set of speakers, and for putting the whole conference together. In this capacity, I was thrilled to gather such a fine set of distinguished academics to present thoughts and ideas from accounting academics, which is the topic of this session. These professors have all made substantial contributions to the academic literature on accounting for sustainability and responsible investing, and they have also provided thought leadership that has had a substantial influence on standard setting, regulation, and policy making. I will introduce them very briefly, and then without further ado, ask them questions which I believe will be of interest to the wider audience of the conference in general, and to the target audience for CARE, which is younger accounting and finance faculty from universities around the world. CARE strives to help these faculty generate and develop research ideas and to encourage innovation in their teaching. Our four distinguished panelists are Richard Barker, who is Professor of Accounting and Associate Dean of Faculty at the Saïd School of Business, University of Oxford; Bob Eccles, who was the founding chairman of the Sustainability Accounting Standards Board, the SASB, and is a visiting professor of management practice at the Saïd Business School, also University of Oxford; Christian Leuz, who's the Joseph Sondheimer Professor of International Economics, Finance and Accounting at the Chicago Booth School of Business at the University of Chicago; and Shiva Rajgopal, who's the Kester and Byrnes Professor of Accounting and Auditing at Columbia Business School in New York City. So I'd like to begin with a question for all of the panelists. Traditional financial accounting information with which we are all familiar has been used in many ways, including, for example, as an input to enterprise valuation, as important metrics for performance evaluation, as the basis of key ratios in debt contracts, as key metrics in investment decisions, as a basis for resource allocation. The question is, can data be developed, or is it already available, that would allow meaningful use of sustainability information in these roles? Associated with that question, what are the impediments? What are the challenges to using or developing sustainability information? What are the roles of the auditor? What are the pitfalls in using and developing these data? That's a lot of related questions. So perhaps we'll start with you, Christian, for some comments on these questions and your experiences in addressing these issues.
Okay, well, first of all, thank you, Peter, for having me on this panel and putting together such a terrific event and on this very important topic. Now, as for your questions, let me take a bite at a few of them and then hand it over to the others. I think the first question that you asked, which was, can the data be developed and used in these roles that you outlined, is relatively easy to answer. I certainly think that sustainability information can be material and relevant to these roles and hence be used, say, in enterprise valuation, performance evaluation, or contracting. Firms have exposures to climate change. They face sustainability risks that investors want to price. And so investors will seek data to price these risks and exposures. And in my mind, to just draw an analogy here, this is very similar to the use of alternative data. So think, for instance, cell phone location data in firm valuation, right? These location data have been used. They're also non-financial, they're different from traditional financial information, but they're used very successfully by sophisticated investors to make sales or earnings forecasts, are used in event-driven investment strategies. Now, although in the sense that I just described, the use of sustainability information is similar to other new or alternative data, there are also measurement challenges. And in particular, I think there are measurement challenges when it comes to sustainability information, because the relevant data might be quite technical. They might require sophisticated understanding of the business and production processes or the underlying sustainability issues. But again, I don't think that that's so different from other domains. So for instance, think of investors analyzing a biotech firm. They also need to look at medical trial data and outcomes to understand this information and the relevance for the valuation of a biotech company. The final comment I want to quickly make is, if we're talking about the use of sustainability information in a more traditional financial analysis, valuation, or contracting setting, then the type of information that we're talking about is likely information that has more of an outside-in perspective. That is, it will be information about how sustainability issues affect the firm, its value or the cash flows, rather than sort of inside out, how the firm affects the environment or society. But there's a lot of interest in such information, the outside, the inside out information as well. And I think that information will be used in new roles, right? It will be used perhaps to assess whether the firm is a good citizen, whether an investment in the firm aligns with the environmental preferences of the investors, whether consumers want to buy the firm's product. And so in that sense, there's also some new information roles. Let me stop here and hand it over to the others.
Okay, so let me pick up there, Christian. Thank you. And just to agree with what Christian is describing, to add a little bit to it, I think it's important not to make too much of a distinction between sustainable and economic, in the sense that, Peter, you framed the question as sustainability information that's relevant to enterprise value, right? So sustainability information which is concerns the economic exposure of the business to considerations of sustainability. The information of that type is not so different from much of the other information that we currently use to value companies. It's just that sustainability concerns have become more prevalent. So information with a sustainability lens is becoming more important to consider in the context of determining enterprise value. So if you think about the relationship between financial accounting and enterprise value, I think we would generally find agreement that financial accounting is useful information in the determination of enterprise value. And we'd also find agreement that it's not sufficient information, right? There's a big gap between what you can learn from the financial accounts and the information that ends up in the stock price. And sustainability information, in a sense, is no different from that. And likewise, the measurability, I think, is no different. So there are some things that you can measure relatively straightforwardly in financial accounting, or in a sort of narrow financial, through a narrow financial lens, like revenue or something. And you can measure something like carbon emissions very straightforwardly. So there's nothing inherently subjective or wishy-washy or uncertain about measuring your historical level of carbon emissions, and quite the opposite. On the other hand, there are things that are very difficult to measure. What is an entity's exposure to the impact of climate change 5 years from now? Who knows, right? That's part of the enterprise value calculation. It's very, very difficult to determine. There are things in a more narrow financial world, as it were, that are difficult to determine. So, the internally generated intangible assets, we don't try and put a number on because we don't think we can, essentially. So I think one shouldn't overplay the distinction between the sustainable and the economic, especially if the framing is one of enterprise value determination. And one shouldn't overplay as it were, the measurability of financial in comparison with the immeasurability of sustainable. I think they're not so different. But to come back to Christian's point about the outside in and the inside out, it's important to keep in mind quite distinct lenses on sustainability. One is the exposure of the business to sustainability concerns. This is the exposure of the enterprise value of the business. The other is the impact of the business on society. And those two frames of reference are more aligned than they might at first sight appear, again, for the reasons Christian described. If your impact on society affects your license to operate affects your sales, the willingness of employees to work for you, and so on, which in turn influences your enterprise value. So they're conceptually separable categories, but not entirely separable. And with that, let me pass on to Bob, I think is next.
Thank you, Richard. Bob?
Thank you, Richard. And Peter, thank you for the invitation. I don't know how I got invited to this. I mean, my co-panelists are like real accounting professors. I'm like a pretender or something. I kind of snuck in here somehow. I don't know how that happened, but I'm pleased to be here. Let me pick this up in a slightly different way, building on what Christian and Richard said. So my PhD is in sociology, and I kind of look at the world that way. And so the first point I'd say, it's been interesting to me to watch as the IFRS Foundation has worked to establish this International Sustainability Standards Board, and we can talk about that later, is that there's quite a strong ideological component to the discussion that's taking place. There are people on the right, like some SEC commissioners, not to mention any names like Kester, who would probably deny that sustainability is important to enterprise value creation, that it's like a transfer payment. And there was a speech she recently gave, I read about this morning, that this is all kind of a smokescreen for rating agencies and data providers and auditors. On the other extreme, you have people that say it's a shame that people are only looking at enterprise value creation, not what Christian was talking about, the inside out, that this should all be about the impact that companies are having on the world. And so on the one hand, there is this kind of technical question of can we get standards, and I'll come to that. On the other hand, it's interesting to me to see how an issue which you think is, relatively arcane and prosaic, setting standards for reporting on information, is really turning out to be a lightning rod for different ideological point of views. And I think we need to recognize that overall context in which it's happening. We're seeing it play out, differently in the US compared to the EU, where they've got the EU taxonomy. And then kind of in the middle, you've got the ISSB. The other thing I'd say, kind of building on what Richard said, is that, the distinction between the financial and the sustainability and what's easy and hard to measure, we've seen this movie before. We saw this movie in the United States when the SEC was formed in 1934. Before that, a little bit of history, there was a bunch of accounting firms. They all had their accounting standards. They all had their own sort of, auditing standards. They didn't compare. Listed companies didn't have to report. A lot of them didn't report revenues. It's like, oh my God, if we report our revenues, the sky's going to fall because competitors are going to know. SEC comes along, says our mission is to protect investors. I could stray from that somewhat. That's a different topic. So we're going to protect investors through transparency. We're going to have standards. We're going to have reporting requirements. We're going to have apples to apples comparisons. Accounting profession said, oh my God, this is as much as art and science. You can't tell us that there's standards. The company said we can't report. It's always been a contested terrain. We take financial accounting standards and reporting requirements for granted. It's still, when a new accounting standard comes along, it can take decades to resolve things like goodwill. These are social constructs. These aren't sort of technically, scientifically based metrics. There is an underlying body in double entry bookkeeping. I get that. IFRS is a social construct. US GAAP is a social construct. It's how we've agreed to represent the reality of a company's financial performance. We are just in the early stages of doing that same thing for sustainability information relevant to enterprise value creation. These will be social constructs. We need to come up with a set of standards. It will be, like all standards, a negotiated process between companies, between experts, and between investors. It won't be perfect. There will always be disagreements. But eventually, I think it will sort of get baked into the way investors make their decisions, the way executives get compensated, the way they report. And it's worth noting, when you look at the responses to the IFRS Foundation's consultation to establish an International Sustainability Standards Board, the support from the investment community was overwhelming. The investment community, the big asset owners, the big asset managers said, look, we want, for the reasons that Christian was talking about, we want a set of standards on enterprise relevant sustainability information so we can bake these into our models, so we can do analysis. And that's the direction of travel. And I hope we get there.
Thanks, Bob. Shiva?
Thank you, Peter. And I hope to have the last word here. So, so Peter said that our audience is mostly junior academics and maybe the investing community at large. So I just want to frame my comments as a series of questions. To me, these are open questions, and everything that Bob, Christian, and Richard said are interesting. But I'm just asking for evidence on some of these questions. So the first, and before we start, I just want to qualify that my bias is more from an investor perspective because of the the firms I work with and what I teach. And I've often found it pretty challenging to show links between just associations, forget causality, between so-called ESG information and either stock returns or a firm's future cash flows. And why is that? I think to me, this E and this S and this G are, there's three different concepts which are almost slapped together. There's a lot of work on G in the past, inconclusive work, partly because we don't know what boards do. We can't agree on excessive compensation and so on for CEOs. The E and the S parts are new. And it's a bit of a definitional mess. What is S? Is it labor? Is it corporate citizenship? Is it political giving? And that kind of makes me a bit nervous because loose definitions effectively mean things are not falsifiable. So ESG is what the beholder wants it to be. Is like one comment. So is there good evidence linking ESG to just operating performance and stock returns? So that's comment number one. So comment number two, when I say this, people often say, oh, no, it's not about the firm's cash flows. That will happen in the future when there's a carbon tax or something. It's about externalities. Okay, so let's talk about externalities. What objective function has the social planner written down in terms of fixing externalities? So there's one paper, and this is just one paper, and more work needs to be done. We've looked at the UK's gender pay parity rule. We couldn't find much at all, both in terms of resolving pay parity there or in terms of future cash flows. So if we say it's externalities, let's produce good evidence to show that it matters to someone. When carbon emissions data gets put out, did emissions actually fall, etc. So if it's externalities, let's look for some data. If it's the firm's own cash flows, let's look for some data. And then you can push this further. Peter mentioned the assurance function. So I've looked at some of these so-called ESG auditors. Many of them are, maybe it's early stages, maybe it'll get consolidated, but as of now, there are a bunch of small firms, not sure how many people actually work for them, like 100, 200. How much primary work do they do in terms of verifying things like carbon? Can they survive one lawsuit if there's do they have the capital to do that? It's all up in the air. Then we can ask deeper questions, right? So whose job is it to police the tragedy of the commons, which is, I think, what's being raised here? Is it the government's job? Is it the investor's job? Who's more effective? And there are other things one can ask. You can. So the investment community's response has been to change allocation of funds assigned to so-called sin stocks or oil and so on. So that's one response. The other response is shareholder engagement, like the Engine One Exxon situation, and now you also see a lot of ESG shorts coming out. The third is reporting. So which of these mechanisms is more effective, if any, at dealing with social change? Four, reporting is important, but I think there are even bigger issues to worry about, especially with climate. And I would just highlight three of these. One, the whole green premiums idea. The idea being that, how much does it cost to switch to a relatively carbon neutral technology? And that cost is tremendous. For instance, an economy class ticket will probably go up by 300%. At the very least. So the interesting thing to watch are these green premiums. Is there technology that will actually bring these green premiums down? The whole climate tech area. How many firms can even survive a $50 carbon tax? I just ran some crude numbers. 2/3 of US firms the profits will get wiped out. So, will these costs be passed on to consumers? The EU is already talking about an import carbon tax, as you know, as we speak. And the last point, if I may, is that based on some crude numbers, if you look at Scope 1, Scope 2 emissions for US companies, at best, even if you discount things like double counting, they account for roughly 40% of the US's emissions. So where is the rest? And given the big role that governments play in the G7, I would conjecture that a lot of it is sitting on the government's books, either through state-owned enterprises and so on. So, it would be nice if governments become the change that they want to see from the private sector. So where are their ESG reports and what progress is being made along those lines? In any case, there are a whole host of issues to look at. It's a very exciting area for academic accountants. There is quite a lot of evidence out there right now, but my worry is that since it's early, I'm not sure it's super reliable, or some of these papers, in my experience, don't even replicate. So I just urge people to be a constructive skeptic, if you will, in this area, and keep pushing and document more evidence.
Thank you, Shiva. I think we covered a lot in those four introductions. I have a number of questions that have come out of those comments, but I wonder if first some of you have questions for one another. If not, I'm happy to raise some questions.
Could I just make one point to Shiv? I mean, I think, the comment that he's made about the lack of research demonstrating the link between ESG by whatever name, and I think a lot of the comments that you make, Shiv, about it not being well-defined or accurate, to me, there's a little bit of a chicken and egg problem, because when you look at trying to do this research, again, going back to standards, we can do financial analysis. We've got accounting standards. We've got stock prices. What do you use? We don't have standards. Do you use MSCI ratings? Do you use Sustainalytics ratings? They don't agree with each other. Company reporting isn't very good. You can't really compare it. So my argument would be, and I think this is why investors want it, if you had a set of standards, and setting those standards will start to clarify some of the issues that you raise. I mean, precisely what do we mean by E? What do we mean by S? What are the material issues? I think if we had standards and we had better quality information, like we have with financial performance, we'd be able to do better research.
Can I also, since we're on that performance topic, and we might as well sort of, maybe discuss that a little bit more, is I would disagree somewhat with the notion that there isn't that much evidence out there on the link between ESG metrics of some sort or ESG performance and corporate outcomes. So if you look at, there is hundreds of studies that have been conducted on this, and there's a number of meta studies that try to sort of aggregate this. And I think the two big ones that I've seen that are also fairly recent, the Atz et al., and there's one by Frieda Bush and others, that would suggest that on the corporate side, the evidence seems to be that ESG metrics, good ESG performance, is positively associated with corporate performance. The big question in my mind about that research is to what extent that could be reverse causality. So rather than, that firms do well by doing good, it's that firms, when they, do well or they make a lot of profits, that then they also invest in ESG, and that introduces some kind of reverse causality. But the evidence is certainly there on the corporate side. Where there is little evidence, it's on the investor side. So a lot of the evidence that more recently has been produced on returns seems to suggest that it's not clear that there is a premium. It's not even conceptually clear that there should be a premium. Many of the green stocks probably should have lower returns, at least in expectation. But because of the shift that we have seen into green stocks or ESG funds and so on, I think that in part explains why there was such a, there have been sort of large positive returns for a lot of the ESG stocks in recent years, and in particular in the COVID crisis.
Okay, so first to Christian, because it's easier to remember his question because he just talked about it. So Christian, the thousands of studies that you refer to, the meta studies, etc. My understanding is that they rely on ESG ratings. Most of that is KLD. And, I've spent a lot of time trying to understand what KLD actually captures, and I'm none the wiser for what it actually captures. This is a point that Bob Eccles made as well. So, these, as far as I can tell, these ratings at best capture headline risk. The idea being that if, Nike is accused of using child labor in Bangladesh, that shows up as a demerit. So the kind of things that these rating agencies claim to measure, in my view, are not measurable at all. They're incredibly difficult. And if you ask them, they'll say things like, "Oh, we use public data." And what is that? As far as I can tell, it's an NLP based analysis of thousands of news articles. If you ask them about, then they'll say things like, I use survey data. I said, I've run a bunch of surveys. What do you do with things like non-response bias? I don't get satisfactory answers. So as far as I can tell, inductively, these ratings at best seem to capture NLP type headline stuff. And I'm not sure how reliable all that evidence is. In my mind, it's not. And to Bob's point, do we need standards? Absolutely, yes. And what can you do in the absence of these standards? So I have a couple of papers where we try to look at enforcement records. We just compile enforcement data across a series of US agencies. There are hundreds of them. There's a whole noodle soup, as you know, OSHA, EPA, etc. That's not terrible data. That's objective data. These institutions don't necessarily coordinate and go after companies. They have their own policing functions. Certainly, there's selection issues there, but at least it's verifiable. It's replicable. It's transparent, and at least based on that, if you buy those metrics, we don't find anything. The firms that claim that they are stakeholder friendly, the business roundtable firms, or even these self-proclaimed ESG funds, if you look at their holdings, if anything, their enforcement data in the past is actually worse. Now you can come back and say they're going to be better in the future. I don't know. I don't know how to falsify that. But anyway, just a couple of things for.
So I've read that paper, Shiv, and I love that paper because I am like a big cynic of the Business Roundtable. They come out a couple of years ago. Oh, the statement of the purpose of the corporation, blah, blah, blah. It's the best thing since sliced bread, our white paper in 1997, whatever it was. Oh, we didn't have to tell our board. You talk about that because we've been, a purpose corporation forever. And I'm like, right. And so your paper comes out and says, well, this is like, to me, empty rhetoric. It's like greenwashing. You look at them, their performance, actually on some things, you showed that their performance was worse. So I love that paper. I mean, because it's like, let's be authentic if we're talking about purpose, and what you show is they're not. So good for you.
Thank you, Bob. I'm glad we agree on something. That's good.
I wonder if we could move the conversation a little to the question of, should accounting for sustainability be mandatory? Should it be mandatory just for listed companies, private companies, not-for-profit entities, governments, etc.? What should be the basis of that mandate? Who should mandate? Maybe Christian, since I know you have a paper on this topic.
Sure. So, I mean, this is actually a question that we kind of hypothetically asked a couple of years ago for a report we did, and then the world around when we were working on this report shifted, and I think at this point the mandate is very much on the table, and so we've sort of recently updated and finished this paper's forthcoming in RASC that kind of asks this question for the US and tries to collate basically the evidence that's out there on the potential economic effects that would ensue from such a mandate. And that's obviously a very difficult question. And some of it is where we're doing some informed speculation based on sort of either work that's out there or our understanding of some of the underlying sort of economic issues. Based on that, I would say it's sort of impossible to say whether the should question in my mind can't be easily answered. Or people say that there is a strong case either one way or the other. I don't think that based on my read of literature that you can make this. But there's a couple of different ways to sort of approach this question that's important here that I want to touch on. First, I would say it's important to state and remember that firms already have to provide or disclose sustainability information to the extent it is financially material. Certainly in the US, that has a materiality-based disclosure regime, and the SEC has sort of clarified that and is looking further into clarifying this further and enforcing this better. So from that perspective, the US system doesn't distinguish and says, oh, if it's E and ESG, you don't have to disclose. It's only if it's financial. The question is it financially material? And if it is, you'd have to disclose it. So in that sense, it depends a little bit on what we think the purpose of the regime is. If the idea is that we want to primarily inform investors about financially material information, and that's the purpose of an ESG regime, then I would say we already have that basic mandate in place, and then the standards would be useful. And in terms of clarifying what does actually financially material mean in the context, because I think some of the dissatisfaction that investors have with the information that they're getting have to do with the fact that it's often not clear what is maybe financially material. Some of these things are relatively new. Some of them depend on things that Richard mentioned about things that come down the pike 5 years from now. So in that sense, the standards do have a role, but I think they wouldn't be expanding the mandate. They would largely be clarifying what does financially material mean. But you could also say that a lot of investors have an interest in sustainability information because they have these non-financial preferences. They're interested in corporate impacts, as we were discussing earlier. In that case, if you now, and I think that's very much on the table, that firms will get asked to report their greenhouse gas emissions, for instance. If we go down that path, then I think we would expand the reporting requirements. And in that case, I think it would be clear based on the accounting literature that we have and work in finance, that if there's new information that's coming out there, that markets will try to price that information. I think that information will have the traditional capital market effects. You could see that could potentially improve, liquidity or have cost of capital effects and along those lines. But we also know from the literature that it could have proprietary cost effects. So it could be costly to firms because they're revealing things to their competitors, to their customers, or their suppliers. And we also know that forcing firms to disclose information can have real effects. Firms will adjust their behavior, and those real effects are really difficult to predict. Some of them may be intended because we are trying firms to kind of, move in the direction of internalizing their external effects and the externalities that come with greenhouse gas emissions and so on. But some of them might be unintended. And I think predicting what the net of this is what's difficult, and why I think the question of, should is so difficult to answer.
So I just sort of say there's a natural experiment that's going to happen, right? That you guys could do the research on, because I don't know how to do this kind of empirical work, but here's the experiment. Then there's a little bit of a wrinkle to it. So the EU's moving ahead, and they're going to have their CSRD, and it's going to be mandated, and legislation is going to pass in April of next year. And it's going to be single and double materiality. It's the inside out and the outside in, Christian. And so you're going to have European listed companies, and it's go down to private companies, but we'll put that aside for now, that are going to have much more burdensome reporting requirements than I think is going to come out of the US, which will probably be more limited. It'll probably be on a kind of comply or explain, going back to regulation SK if it's material. So it'll be very interesting to see, because if the cost burden is high and if we're revealing information, that may be to the disadvantage of a firm, one would hypothesize that, controlling for everything else, the way you guys know how to do, that European listed companies, just by sector and stuff, their performance will be less, than US companies because of the reporting burden, because of these disclosures, or maybe not. You could say, investors have got a better view on the impact, the universal owners, the system level people. So I think there's an interesting possible research project, that people that are in the audience could think about. What complicates it some, and I'm trying to get my arms around this, and I was talking to somebody at S&P last week, they're coming out with a report in the next couple of days, I think, on what are the implications of the EU taxonomy on US companies, because it's not public and private, it's 50,000 companies. So what it's beginning to sound like to me is that US companies that have subsidiaries in the EU are going to have to report according to the CSRD. And it's even possible that US companies doing business in the EU are going to have to report on that as well. So you're going to see kind of out there in kind of the mandated regime, whether it's good or not, we can all debate it. But, over the next year or two, we're going to see some fairly major changes in what the company reporting requirements are. And I think it'll be the basis for some very interesting comparative research.
So changing the topic a little bit, although not that much. So what's the role of the auditor in all of this? I think a lot of the people in the audience come from the audit profession. What's the role of the public audit profession as it now exists? Is it equipped to do the auditing? Should they become equipped if they're not already? Should they be carbon auditors, or is it for someone else?
Yeah, can I pick that up by extending the discussion that we just had about what gets mandated, because these things go hand in hand. I think so I think on the mandating question, there are two different purposes for which you might mandate standards. One is for the purpose of investors, and the other is for stakeholders in society other than investors. Again, this is sort of the outside in and the inside out perspectives. From the investor's point of view, I think that as Christian describes, we already have a broad framework of financial materiality. What we don't have is a way of codifying what that means in the context of sustainability information. And so I think the role for sustainability standards in that mandatory standards in that context is very similar to the role of IFRS or US GAAP in that context. It's going beyond saying, yeah, you need to produce financially material information to, in a sense, providing the public good of saying, well, this is how you do it. The link to auditing there is once you've taken the step of identifying what is measurable and what is not, and thereby what is auditable and what is not, and what gets included in the required reporting in order to enhance consistency and comparability and so on, then you have a role for the audit profession. I think the audit profession has been reluctant to get into this space so far because they don't have that. You know, there's nothing, as it were, either unambiguous or mandatory that needs auditing. You know, if you think about auditing IFRS, it's not only required, and therefore there's a need for the profession to be involved. It's also a much lower litigation risk in getting involved in auditing stuff where no one's quite sure what the rules are and what you can say and what you can't say and so on. So that's on the investor side. On the sort of broader public interest side, I think the mandate comes from government. And it comes from government to provide information that serves the public interest. So, for example, you know, if the government wants to introduce a carbon tax or something, then it makes sense to have mandatory reporting of information that's consistent with doing that. And again, then you need an audit function. So, I think the role of audit is not yet. I think the codification needs to come first.
I'd just like to add on a little bit, Shiv. This is another thing you and I agree on. Believe it or not, we're finding points of common agreement here. When you commented earlier about the assurances done on the sustainability information, it's a joke, right? It's these little firms, companies paying, you know, $50 million a year for their financial audit and $50,000 to have someone come in and put a good housekeeping seal of approval on their sustainability report. It's a joke, right? It's not even, you know, sort of negative assurance. So when we get to the standards, as Richard was talking about, I think it's basically the big accounting firms, the big four, they should do the audits. They should be integrated audits. And you can see pressure starting even now, and this is something Richard can speak to more directly and inform than I can, of whether or not the financial audits, even before you've got reporting requirements on carbon emissions or whatever, you know, is climate being taken into account in the way that the financial audits are being done? And I think that's another interesting area for research. You know, David Pitt Watson, a friend of Richard and mine, is doing a study, and you're starting to see through so-called key audit matters under IFRS and critical audit matters, you know, are we even today through the materiality lens that Christian was talking about, are the audit firms now, the big four, which do most of the market cap in the world, are they sufficiently taking account of, quote, sustainability, largely from a climate dimension at this point, in the way the financial audits are being done today? Maybe, Richard, you want to elaborate on that a little bit?
Well, I mean, I think this links to the point about reluctance of the big audit firms to become involved in the space. I mean, they're not yet geared up to be able to do so. So I think what was going to happen here is that there will be standards that are introduced, and then the audit firms are anticipating a significant market demand and will gear up enormously into that space, but don't yet have the technical skill set to do so.
Peter, if I may, just a couple of quick observations. One, I'm puzzled by, so as you know, class action lawyers are very aggressive in the US. They jump at you for any, perceived or other transgression that you didn't disclose something. So I went and looked before getting on this call. There are very few class action lawsuits alleging that firms aren't disclosing climate risks. And I'm just posing that as a question. I don't know why. So it's interesting that there aren't too many of these. So if investors really wanted these disclosures, this is something that Bob alluded to as well in the audit space. I think it's worth looking at the class action space. One other just purely scholarly point. Peter, as you know, Peter and Christian, a lot of academics used to get very excited about competition and standard setting back in the day. Remember Diane Sundar and so on. So this is a laboratory to go test that. there's a lot of competition in the standard setting space. There's the SASB, there's TCFD, there's PRI, there's so many of these. And Bob, I'm sure, will have interesting insight. So how does the sociological shakeout happen here, and who eventually becomes the so-called platform setter would be fascinating to understand.
Let me just a quick comment on what Shiva was just saying, which I think is very interesting on the litigation risk. I think that certainly for the researchers that are listening to this be an interesting question to sort of go further down and just to venture a guess as to what this could be related to. If we think about climate risks as externalities usually, and if there truly are externalities, then almost by definition, that implies that the financial consequences for the firm are small relative to the social cost, right? And that would indeed say that a lot of the issues when it comes to climate, certainly for the firms that are not in carbon regimes, would at the moment be financially not that material, right? And I think that is potentially one explanation for why a lot of the firms are not providing more information, or why it at the moment isn't a pressing short-term concern for investors. More long run, and as we're going to hit sort of the cliffs with various climate regimes coming into place, then I think these issues will become financially material, and then will eventually also have implications for enterprise value, like Richard was saying in the beginning. But my guess is at the moment, a lot of the greenhouse gas emissions truly are externalities, and therefore are financially, relatively small in terms of the consequences, direct consequences for the firm that the firm is internalizing. And that's sort of why I think that could explain some of the things that Shiva was talking about.
I think I'm no lawyer, but I suspect that the place to look here is not investor lawsuits, but NGO lawsuits, actually. So lawsuits that in the context of breach of environmental legislation or environmental commitment, of and preventing economic activity. So a couple of very large recent examples are the prevention of the expansion of Heathrow Airport and the restriction of Shell's of the exploration activity at Shell. So if you look at an organization like Client Earth, which is set up to litigate in this context, they're very effective at they pick their targets, and the consequences are economic for the corporation. So that's probably a better space to look empirically, I would think.
Look at lawsuits, you've got to go to the professionals, Richard. You've got to come to the United States. I know Client Earth is based in the UK, but litigation is a national pastime. It's our sport. You guys do football, we do litigation. If you want to learn about litigation, you got to come over here, Richard.
I've often heard the expression of concern along the following lines. Even the choice of what is measured matters, because measurement in and of itself may affect the decisions of the entity that is measured. Thoughts on this issue?
I mean, I've gone first on the. Richard, do you want to go first on this one, given that I've gone the
Yeah, so the question is whether measurability matters, Peter.
So does the measurement itself affect the actions? And I think the answer to that is yes. So how does this affect our choice of what will be measured?
So, as Shiva was describing the difference between E, S, and G here, if you take the difference between E and S, S is not well defined in the first place. So if you press different people on what the S means, what is social capital? What is the concept of sort of social impact and so on? You've got a whole range of different answers. If you then press that to be, well, how does it relate to enterprise value and why? What are the mechanisms here? You'll find even fewer answers. So there are things there that are measurable, but nothing you can sort of put together to create some sort of construct of social capital. In the environmental space, the carbon stuff is very measurable if you're looking at emissions, especially scope 1 and scope 2 emissions. It's also measurable at scope 3, so sort of downstream and upstream being easier, with some way off being able, having the systems in place to do the measuring, but in principle, very measurable. If you think about something like the scenario data required by TCFD, what would the impact on your business be if there was 2 degrees of climate change? That's entirely immeasurable, right? You can't measure something that hasn't happened yet that involves all kinds of speculation. So there's clearly huge variation, huge variation in what it is that we're measuring and in whether or not you can measure it. And I think it's hugely impactful. So, when companies make carbon commitments, they will tend to be scope 1 and 2 because that's relatively measurable and defensible and so on. And scope 3 can be sort of ignored and sort of put out of the frame of reference and the sort of the dialogue because it's sort of put in the, like a sort of difficult provision. It's put in a too difficult to measure bucket. As our measurability of scope 3 improves and as social pressure around scope 3 improves, you're going to find it increasingly moving within a frame and becoming increasingly auditable and increasingly a matter of social license to operate and so on. So I think measurability really affects whether something makes it onto the board agenda. So if you think about, again, back to just briefly, back to the social capital issue, what ends up being measurable and looked at and so on will be a subset of things that happen to be picked, that happen to be framed, as opposed to things that are not. Whereas on the natural capital space, I think you can find a much more direct relationship between things that get measured and planetary boundaries and science-based targets and so on for environmental impact. So there's a much more, if you like, meaningful measurability in principle in that space.
Could I build on that just a little bit? I mean, Shiv raised the question about how important is reporting versus, activist ownership, like engine number 1, which I was pretty involved in, and government policy. I mean, it's a fair question. And I think it matters more when there's commitments that are made to targets. And standards aren't targets. So a company can say, we're going to be net zero by whatever date. What standards do is enable you to sort of say credibly, are they accomplishing that or not? But standards don't set financial targets. Companies will give guidance, to the analysts and whatever, we're going to grow by this much. So I think the reporting and what they choose to do and how measurable it is, the strength of that is going to be enhanced by when companies make commitments about what they want to achieve in terms of hitting targets in the future, that the standards go along with. The reporting by itself, without targets, without investors, without stakeholders engaging with them, then I think that the impact is less.
Maybe, Peter, your question was also in part to what extent the measurement itself, kind of matters and affects decisions. In my mind, that is the reason why I think we need the accountants to be involved, right? The way I think about accounting is it's a discipline that is about measurement, and the accountants are experts at measurement. And I think we in this space, we definitely need also engineers and people who understand the sustainability issues from a more technical perspective, but we also then need sort of the accounting expertise. What does that mean in terms of financial terms and the financial implications for the corporation? And we have quite a bit of work in economics and accounting that would support the notion that the measurement clearly matters, right? So to me, the paper that always comes to my mind in this context is the famous Drainov et al. Paper that analyzes these hospital report cards on health outcomes, and where they basically look at mandatory report cards for bypass surgery, and they provide mortality rates, and they find that the measurement, or the fact that they then disclose that, had some positive effects, but more importantly, gave doctors and hospitals an incentive to decline to treat the more difficult and severely ill patient. And that's clearly a negative effect that would not be intended. So on net, we actually had worse health outcomes, particularly for the sicker patients. Now, the question is, why does that happen? That's clearly sort of related in my mind, is not because transparency or disclosure is a bad idea. This is a good example of a measurement problem, right? When the hospitals and doctors provide the mortality rates from these surgeries, there's no adjustment for the patient pool and how sick the patients were on their way in. And in my mind, that example sort of illustrates, well, how important it is for us to get the measurement right if we want to set incentives for companies to behave in environmentally sort of sensible ways or friendly ways, or we're trying to achieve certain, social goals with the reporting regime that we're implementing.
So, Peter, let me share a positive story. We often think of this in a negative context. There's some unintended negative side effect of reporting. So I know from personal experience that, because companies are paying more attention to whether their suppliers actually follow certain labor standards, they have a better handle on who their suppliers are. And the whole chip shortage problem now, I think, could have been alleviated somewhat if people knew who their suppliers were. And I'm talking about tier 1, tier 2, tier 3, and the suppliers, which you sometimes don't know about. So that's one of the nice things. That's one of the positive side effects of this whole supplier responsibility movement, which is part of this whole ESG thing.
I'm conscious of the time, and I'd like everyone to just give a very brief answer to what's a pretty long question. We have, for example, been talking for decades about measurement of fair value, and we're still debating. It seems to me that it's a possibility that we could find ourselves talking for many more decades about issues accounting for sustainability, auditing the measurement, uses of the accounting. But as I talk to the participants in this conference and the various speakers, I feel a great sense of urgency. I'm curious about your thoughts on the urgency. What should we do to accelerate the decisions? What should academics and practitioners do to inform the decisions made by standard setters, regulators, etc.? Just a brief response from everybody. Maybe start with you, Christian.
Sure. So, I mean, my first reaction would be that I agree with your sense of urgency. I think given the irreversibility issues that we face with respect to the climate or biodiversity, it's in my mind important not to let the perfect be the enemy of the good. Right. At the same time, having looked at this literature overall pretty carefully, worked on the notion of real effects, I do see a great amount of potential for unintended consequences from sustainability reporting. In my mind, again, given the urgency when it comes to climate, I would not necessarily let that stand in the way. But because if we were to go into a full-blown sustainability reporting regime, the audience is so broad, and we know that firms will take the various stakeholder responses and audience responses into account, I would be worried about these sort of unintended consequences. And so putting this together, I would favor sort of an approach to sustainability reporting that starts with the core issues where there is urgency. So that would probably be greenhouse gas, climate, maybe biodiversity, build the infrastructure for them, focus on them would also bring more speed, allow us to learn, how to report on these issues to, again, build the overall infrastructure for it. And then we can consider sort of expansions in other areas that are also important. That would be sort of my quick response.
Thanks, Christian. How about you, Richard? Thoughts on the urgency?
Yeah, so I think the first question will be urgency for whom. So, for society as a whole, the challenge of climate and biodiversity and so on, there's no question that there's an absolute imperative and urgency. That's very clear. For the individual corporation and the stock price of that corporation, the urgency is far less clear. It's a tragedy of the commons kind of situation that we face, right? So the challenge, I think, is to reconcile those two different worlds of urgency. And in that, information and disclosure, I think, is really, really important, and it's important, shouldn't be understated. So the extent to which society as a whole doesn't understand the collective urgency of addressing the climate and biodiversity challenge is a real problem. So the more that it becomes clear to society, to investors and to others, of the extent to which business models need to change and consumer behaviors need to change, and there are things that enable business models to change, the better. And we don't yet have the kind of information that enables people to make those judgments. So I think more effective corporate disclosure is actually critical in as it were, addressing and tragedy of commons issues and reconciling the difference between the urgency that we all face and the absence of urgency that's currently felt within the corporate sector, individual corporations.
Thank you, Richard. Your thoughts, Shiva?
So, if there's regulatory consensus that this is urgent, I think it has to be a combination of regulation and maybe technology. I'm not sure that reporting is a first order worry if you're trying to solve climate change. People, if you force people to do things that are not incentive compatible, they just won't do it. So greenwashing, I think, is more the equilibrium than the exception. So it has to be some combination of regulation and maybe the whole green premium issue. can we bring the green premiums down? That's what I would worry about.
Thank you, Shiva. Bob, you have the last word.
I get the last word, Shiva. So lucky me. And I know we're short of time. So your fair value example proves my point. Social construct, right? It's not simple to do, and we can argue about it just like this other stuff. Look, we all know that this is urgent. I think, Shiva's comment is right in terms of, you need to have regulation. I think the technical issues around, carbon and biodiversity, they're much simpler than the social issues. The ISSB can do it. They can't require these standards. Then it becomes a question of political will and regulation. Is the EU going to be a spoiler in one way? Is the US going to be a spoiler in the other way? So if you can get under the foundation, move quickly on climate, on biodiversity, get some standards, and then to have, those standards be mandated by whatever fashion, maybe a little bit different in the US and Europe. And at least if we have some different regimes that when we're talking about carbon emissions, we're using the same metric. So it's comparable, just like we've got comparable in terms of revenue recognition. Then I'm pretty optimistic it can move fairly quickly. You'll need some cultural differences in the way the ISSB works compared to the ISB, but I'm kind of cautiously optimistic, on solving the technical problems, a little bit more nervous about whether there's sufficient global political will on this.
I think we've got a couple more minutes if anyone would like to jump in with a final comment.
I would actually I want to just sort of agree with Shiva that if we're talking about urgency, and by urgency mean the climate issue, then reporting alone is not going to be enough. Like, given the panel was sort of more on reporting, I think we can make a meaningful contribution and should think about a reporting regime. But in the end, if the bigger goal is to solve the climate crisis, then we're going to need some regulation, a carbon tax, or it's something that unleashes the incentives to also develop technologies that really address this problem.
Yeah, no, I think that's absolutely right. At the same time, I think information by which stakeholders understand the nature and scale of the problem is a necessary incentive for that regulation itself to come about.
Well, thank you everyone for what I thought was a very interesting, very insightful, very informative, quite provocative session. So thank you all again. Let's look forward to the remainder of the conference.